the CEO of the Chamber, panelists, ladies and gentlemen, let me first thank the CCC for inviting me and giving me this opportunity to share some thoughts with you. What I'd like to do as far as the theme is concerned is to divide it up into two. First, to look at the macroeconomic fundamentals and to make the case that some progress has been made in terms of stabilization, and to also share with you some of the things that are being done to strengthen stabilization further. And then in the second part, to look at the growth framework, and again to make the case that there is greater stability in terms of the growth framework, and to share with you again what is being done to strengthen it further. So essentially, stability in terms of macro fundamentals and the growth framework, and how are we building upon it. So if I can start with the macro fundamentals, why do I say that one can be cautiously satisfied that we've made some progress? I think a reflection of that is the fact that the IMF's executive board completed the third review of the extended fund facility. That was completed successfully in December. We are seeing money coming in, foreign money coming into the stock exchange and the government securities market. Fitch and S&P have taken away the negative outlook on their sovereign rating, and we now have a stable outlook. Of course, Moody's still have a negative outlook, but there has been progress in terms of Fitch and S&P. The international sovereign bond that we issued last May, I think it was, which we issued at 620 basis points, has been trading about 60, 70 basis points tighter. So these are all indications that there is a degree of confidence that is percolating through as far as the Sri Lankan economy is concerned. But we are still on a journey. I'm not for a moment saying that we've cracked it. Far from it. There's a lot more to be done, and I will share with you some of the things we are trying to do. But I feel that we're in the right direction as far as strengthening our macroeconomic fundamentals in terms of stabilizing the economy. Now, as far as growth is concerned, just by way of introduction, we clearly, at the moment, the growth rate is more muted than we would like it to be. We probably end the year with little under 4% growth. In our view, the potential growth rate is about 5.75%. So there is an output gap, which we feel needs to be addressed, and I'll talk to you about some of the things that are being done to do that. But the one thing that has to be avoided at all costs is to try to boost the growth rate by loosening macroeconomic policy in an inappropriate way. This is something we have done again and again in the past. We've artificially boosted growth through inappropriate fiscal and monetary policies, and inevitably there is an overheating of the economy and usually both higher inflation, unsustainable inflation, and a balance of payments crisis. That is the repeating cycle of the Sri Lankan economy, and this time we are determined that we will not go for the sugar high in terms of artificially boosting the growth rate through inappropriate macroeconomic policies. So we want to maintain sound policies and to drive the growth rate through reforms. That's what has to be done, not taking shortcuts which cannot be sustained. Okay, let me now say a little bit about the macroeconomic fundamentals. If I may take each of the macroeconomic policy instruments in turn. As far as fiscal performance is concerned, 2017, there was some slippage in terms of the the overall budget deficit target, which was intended to be 4.7% of GDP. It ended up around 5.2% for good reasons. Almost the entirety of the slippage was due to flood and even more particularly drought-related expenditures. And in fact, the IMF has accepted that, and the 5.2% of GDP deficit for government fiscal operations has something that has been agreed with the IMF. And given the circumstances, it has come out reasonably okay. This year, the target is 4.8%. Now, but there are some interesting things happening on the fiscal side which we need to take note of. There are important structural changes that seem to be coming through. One is, for the first time since 1954, we had a primary surplus last year. And this year, for the first time since 1987, we expect a surplus in the current account of the budget. That is, revenue is expected to exceed recurrent expenditure for the first time since 1987, which means that for every year since 1987, we have been borrowing for recurrent expenditure. So that kind of explains the fact that partly explains the fact that we were second to Japan at the time of independence, and we are now well behind, second to Japan in Asia at the time of independence, and now we're well behind many countries. And poor macroeconomic performance has been a major part of that negative narrative. So we need to get things right. So what are we doing? These structural improvements, which we're seeing to a significant extent, have been driven by the VAT reforms, that is the adjustment in the rate from 11 to 15%, and the removal of some sensitive exemptions, as well as the passage of the Inland Revenue Act. That is being supported by attempts to improve tax administration through the infusion of technology. The Revenue Administration Management Information System is pretty much up and running. And on the expenditure side too, there are moves afoot to strengthen expenditure control and to improve the quality of public expenditure. While our revenue performance pretty much collapsed, in the 80s, when I had a spell of being seconded to work in the finance ministry, 20% of GDP, 21% of GDP was de rigueur. It happened regularly. It went down to a little under 11% 3 years ago. So most of the adjustment that is taking place on the fiscal side is being driven through revenue enhancement. On the expenditure side, actually our overall expenditure at around 19-20% of GDP is not too bad. If you look at our rating peers, that's roughly where expenditure should be. But we do have some challenges in improving the quality of public expenditure, both recurrent and capital expenditure. In my view, there are grounds to believe that there can be improvement in the quality of that expenditure. And I think going forward, we would also need to give priority to the effects of climate change, clearly. And there need to be, the sustainability will need to be mainstreamed into our budgeting and planning processes. So that's what's happening in terms of improvements, in terms of the fiscal performance, which in my view is a major advance in terms of stability. Because the main source of instability in the economy has been the government's fiscal operations over the years. Sri Lanka, if one were to characterize it in the post-liberalization years, from the post-1977 years, has been a high budget deficit, high inflation, high nominal interest rate, overvalued exchange rate economy. 180 degrees, diametrically the opposite of what the successful countries of East and Southeast Asia achieved. So if we can crack the fiscal challenge, we go a long way towards stabilizing the economy, and some progress has been made in doing that. Now, not only, so what about building on this stability that has emerged so far, the government is seriously considering strengthening the Fiscal Responsibility Management Act. The Fiscal Responsibility Management Act sets targets for the budget deficit, the overall budget deficit, and for the debt, public debt as a percent of GDP figures. Now, while it was introduced, I think in about 2002 or 2003, pretty much in every year it has been breached because it lacks teeth. So the government is considering giving teeth to the Fiscal Responsibility Management Act by specifying the reasons why you can go outside the target, why the target can be breached. For instance, there could be a major shock to the economy resulting in a severe recession, in which case clearly you will need counter-cyclical fiscal policy which pumps demand in the system to bring about recovery. So you may have to temporarily exceed the target. That could be a natural disaster, something like the tsunami, which requires major fiscal operations. So it will specify, if we can get this through, the Fiscal Responsibility Management Act will be strengthened to specify when the government can exceed these targets, and then the government must set out how it will come back, the path it will take to come back within target when it exceeds the target. This is really building on the improvements that have been made in terms of stabilizing the fiscal situation by institutionalizing the fiscal targets. Now, related to the fiscal operations clearly are the performance of state-owned enterprises. And here, in the interest of time, I'm not going to go into too much detail, but two major reforms are due to be undertaken this year. And that is the introduction of a cost-reflective pricing formula for electricity. Well, first for fuel, and then for electricity. Over 90% of the losses of the CPC and CEB are due to the fact that they subsidize fuel and electricity. The government forces them to sell at an administrative price below cost, but yet it doesn't recompense them. It doesn't compensate them for the subsidies. So successive governments have been very clever in parking the budget deficit in the CEB and the CPC, and that subsequently gets transferred onto the balance sheets of the state banks. And it's a highly distortionary thing that has been going on forever. So if we are able to get these cost-reflective pricing formula into place for fuel and energy, it'll again remove a major distortion in the system and significantly improve the macroeconomic stability. If I can now turn to the monetary outcome, you will recall that the current tightening cycle started in early 2016. And the last policy rate change was in March of 2016 when we had a 25 basis point increase. But the transmission, there's a significant lag in the transmission of monetary policy. And it is really in recent months that we've begun to see the full effects of the tightening that was undertaken almost started 2 years ago. The private sector credit, which peaked at 28%, is now down to 15%. Broad money M2B, which was hovering little over 20% and was very sticky downwards, has now come down and it's about 17.4%. So we are beginning to see improvement in the monetary aggregates. On inflation, the target that the Monetary Board has been working with is 4 to 6%. However, in recent months, headline inflation has been above the target. It's gone up to even over 8%. This was entirely due to supply-side disruptions due to the weather. food price inflation reached over 13% when it peaked about 3 months ago. Now, there is very little that monetary policy can do to address supply disruption-driven increases in inflation. Excess demand can be addressed through monetary policy. But if there's a supply disruption which drives up prices, clearly the monetary policy can't do very much about it. So that the government has to address through increasing supplies, through imports, and interestingly, this over 13% food price inflation was very largely due to just 2 items, rice and coconuts. The sharp increase in the prices of rice and coconut contributed to the 13% food price inflation, which dragged up the headline inflation above our target. But we are beginning to see it now coming down. And we feel that by the end of the first quarter, headline inflation should come within the target range. I should say that core inflation, which is what monetary policy can influence, has remained well within the target. In fact, on the CCPI, it's 2.8%. The last month the data is available for. On the NCPI, it's higher and a little above 5%, but both within the 4 to 6% target. So that is what we can influence. Now, of course, if headline inflation remains high for a period of time, then inflation expectations get affected. And that leads through to wage pressure, etc. That, in turn, creates demand-side pressures, which monetary policy has to take into account. So the central bank is looking very carefully at what's happening to wages, what is happening in terms of demand side, whether there's any pressure that's emanating. We haven't seen anything so far, and inflation is beginning to come down, and hopefully it'll come down within the target range. Now, what are we doing to install? As I said, particularly if you look at core inflation, there has been stabilization on the monetary front as well. And the supply disruption was an issue, but it's beginning to adjust. So what are we doing to strengthen this stability that we see on the monetary side? And here the central bank is in the process of introducing a flexible inflation targeting regime. I'm going to be very brief because I see I'm running into time constraints. I would recommend that you look at the central bank's roadmap, which was launched on the 3rd of January. It's up on the central bank website. It gives in great detail how the central bank is proposing to transition to a flexible inflation targeting regime. Essentially, it enables a much more forward-looking, proactive monetary policy. In the past, there was fiscal dominance. The monetary policy, much of the time, accommodated fiscal profligacy. And the central bank printed a lot of money, it monetized the deficit, the government budget deficit. We're trying to break away from that and to have a forward-looking monetary policy which is focused purely on the inflation target of 4 to 6%. So not only is this framework being introduced, and you will see in great detail how it will be introduced, it has meant that the central bank has had to upgrade its modeling and forecasting capability, which it has done with the assistance of the IMF. And what the central bank is also doing is to put in the legal and accountability framework that is necessary for a flexible inflation targeting regime. And for a flexible inflation targeting regime to work, there has to be significant central bank autonomy. Because clearly, if it is not to allow the fiscal forbearance of the past, it has to be given the autonomy to do that. So that's on the monetary policy side. On the exchange rate, as you know, the central bank has not intervened in the forex market for some months now. in terms of selling dollars to defend the rate. We're allowing the rate to find its own level in the market. What we have done, though, is to intervene in the market to purchase dollars. We've purchased about $1.6 billion US dollars in 2016, which is basically non-debt creating addition to the reserves of the country. And what is happening now is that with the assistance of some technical assistance from the IMF, we are putting in place some parameters for managing the exchange rate. This will draw on best practice from around the world. And once these parameters are put in place, there will be greater clarity in terms of how the exchange rate is being managed, which will give economic agents greater predictability in terms of how exchange rate policy is conducted. So again, as I said, we're putting in place a framework. And has there been stability in the exchange rate market? I remember at the beginning of the year, people kept asking me, well, will the rate end up at 158 rupees? Will it end up at 160 rupees? Well, we ended up a little under 154 rupees. So hopefully that again demonstrates that there has been some degree of stability which has been achieved in the forex market. But as I said, we are going to put in parameters to institutionalize the way the exchange rate is managed in a market-oriented way. And the forex market itself will be developed. The detail again is there in the roadmap, so I won't take time now. So those are really frameworks that have been put in place to manage the three macroeconomic instruments. And by institutionalizing these changes, we hope we have contributed to making these changes more durable, more resilient. On the external account, the current account deficit came out at 2.9% of GDP last year, 2017. We had hoped it would be 2.3% of GDP. Again, the slippage was due almost entirely to weather-related imports of fuel and rice. The significant reduction in hydro generation and the increase in thermal generation, combined with the shortfall in rice production as a result of three successive cultivation cycles being affected by drought, all that meant that there was a significant increase in the imports of fuel and rice, which meant that the import bill increased. And so we had an increase in the trade deficit despite a noteworthy turnaround in export performance. You would have seen the papers today, there were screaming headlines, a record in exports in 2017. I don't think it's anything to be proud about, this achievement, because we're still way down as far as exports are concerned, but we are on our way up. Exports of goods ended up at 11.4 billion, and I think services are about 3.6 billion, altogether about 15 billion. And you have tourism on top of that. So we're seeing this improvement on the export side, which is really crucial because it's necessary for growth, it's necessary for employment, and it is necessary to get out of this debt situation we find ourselves in. So we need to build on it and keep going. So what are we doing to help the exchange rate? I think the flexible exchange rate is already helping and will continue to help. And the other important thing, I think, which is taking place is the move by the government to first reduce and then eliminate para-tariffs. Over 50% of global trade, international trade, now is accounted for by cross-border production sharing networks, i.e. these global supply chains. Now we have a negligible presence in the global supply chains. I think about 7% of our exports are part of global supply chains. Even India, which is still seen as a largely closed economy, has 22% of its exports linked to global supply chains. And one of the reasons why we have made so little progress is because we've had all these para-tariffs. Because in these modern production sharing networks, the distinction between exports and imports gets blurred. You bring stuff in, you do your little bit, and you send it out. So if you start sticking para-tariffs along the way, you don't get into that game. And that is what has happened. So we've missed out on the most dynamic part of the international trading system by having this misaligned policy in terms of para-tariffs, and the government is removing these para-tariffs over time, and that will certainly open up opportunities to break into these supply chains, which are the most dynamic component of the international trading system. Now, let me say a little bit about reserves. Again, what has happened to stabilize the situation? In 2016, the reserve level was $6 billion. We ended 2017 at $7.9 billion. It has now come down to 7.5 because there was a large Asian Clearing Union payment at the beginning of the year. So it's now at about 7.5 billion. Now, not only has the volume of reserves increased, but more importantly, the quality of reserves have improved. Because short-term swaps, which accounted for about $2.5 billion of the reserves, $2.5 billion of the reserves at the beginning of last year, have now come down to about $1.4 billion. So we built up reserves by $1.5 billion, and at the same time we've driven down these short-term swaps by about $1.1 billion. So clearly this improvement in both the quantity and quality of our reserves is an important factor. Now, going forward, given the bunching we have in external debt, and I'll come to that in a minute, clearly we have to build up a buffer in terms of our foreign reserves. What we need to do there is we are reasonably confident. Now, I've got to be very careful about making predictions, but it would not be entirely surprising if we can push up our reserves to close to $10 billion at the end of this year. Why do I say that? One, there is $700 million worth of non-debt creating inflows from the Hambantota long lease. Then the central bank intends, there is an EFF target of purchasing $100 million a month. So that's 1.2 billion, again non-debt creating. But we feel we can buy, and which we have been doing for the last 7-8 months, purchase about $200 million a month from the market. Even if we do 150 million, that is 1.8 billion of non-debt creating. 700 million of the remaining payment from China, that's 2.5 billion of non-debt creating. There is approval to borrow, to go to the market for an international sovereign bond for 2 billion. Then on Sri Lanka development bonds, there's an incremental 500 million. So if you take all this together, and if our export performance continues to improve steadily, there's a reasonable chance we can get to about reserves of about 10 billion, which we need when we get into the bunching of external debts from 2019. So let me quickly turn to liability management. That's the other framework. Because for most people, the Achilles heel in the economy is its debt indicators. That we have our debt to GDP ratio is way above that of our rating peers. The median is about 45% of GDP, and we are at about 79%. So we are way above, but we are very confident we can manage it. Now, why do I say that? One, the peak in domestic debt repayments is this year. But we have been able to build a buffer of about 110 billion rupees in the last 4-5 months of 2017. Because there were no maturities, and we used that to go to the market and raise some money. And with the help of that 110 billion rupee buffer, we feel we can manage the peak in the domestic debt repayment profile of 2018. Then on external debt, the challenge starts in 2019. Because from 2019, 20, 21, and I think 22, there are large external debt repayments, including the maturity of international sovereign bonds. So what we're doing there is a liability management bill which has just been gazetted. And it will give greater flexibility. How will it give greater flexibility? Up to now, the appropriation bill limits the government's borrowing to the government's borrowing requirement in any particular year. So we can only raise financing to fund the government's deficit. We can't borrow additional money to create buffers to manage the bunching of the external debt. This Liability Management Act, when it is eventually, it's in Parliament, it should be enacted in a matter of weeks. What it does is it gives us the flexibility to do this liability management by allowing us to go above the government's borrowing requirement. There are specific limits set, and it also says you can only do it for a particular purpose, which is liability management. So we're not kind of opening the doors to go crazy about borrowing, but with a limit, and for this particular purpose, the government can borrow some additional money for liability management. What it will do is enable us to raise some additional money, which we can use to do things like buybacks, switching, etc., which will help us to change the maturity profile of the external debt, as well as to reduce its cost. So essentially to manage the debt in such a way, by pushing out the maturities, by switching some of the more expensive debt for less expensive debt, and to manage our liabilities going forward. But this kind of buys time. The way to really get out of it is you have to do exports, you have to do FDI. But this is essentially will give us the framework to manage this situation, and we are confident that we will do so. So those are kind of, as I said, I think there's move towards stability in terms of the macro fundamentals, and there are various frameworks being put in place to make those improvements, to embed those improvements in such a way that they are durable and resilient. Let me very quickly talk about the growth framework, no more than 5 minutes, and then you can ask me questions on it. Is there greater stability as far as the growth framework is concerned? Now, a major problem I think all of you in the private sector have complained about is that there's a lack of stability, that there's a lack of consistency and predictability in policy making. Now, I hope you share the perception that I have that we are beginning to see some improvement, that we are beginning to see greater policy coherence. There is greater alignment between the Vision 2025 document and the government budget. That, I think, is a very good signal that we are likely to see greater stability, consistency, and predictability in terms of policy making. That in itself should strengthen the growth framework. So, in my view, that is an indication that there is greater stability in the growth framework. What are we doing to improve it? There's a whole series of things. As you know, the government has this action plan to improve the investment climate by attacking the 8 of the 10 pillars of the World Bank's Doing Business Index. But anyway, it's nice to know that we might be 89 rather than 111, which was the news that broke today because of some issues the World Bank had. But anyway, we have to do a lot better. And there is that program to improve the ease of doing business indicator. And there's an action plan that's being rolled out. Then the BOI's operations are being made much more focused. They're working with the Center for International Development at Harvard to make the program to identify particular sectors where we have the comparative advantage to enable us to have a more diversified and a more complex export basket. Then we are having trade facilitation, the single electronic window, a trade portal, all that stuff, I think, which you know much better than I do, is being rolled out. And trade policy. I think probably everybody has already heard me say this. That's the jewel in the crown. If we are able to complete the negotiations with India, China, now Singapore, we are signing, I think tomorrow. If we're able to complete those two big trade agreements or economic partnership agreements, we will be the only country in the world with preferential access to China, India, and Europe through the GSP+. No other country has that kind of preferential access. So that is a key differentiator. There are 190 odd countries all chasing FDI. Now these preferential trade agreements clearly will boost the prospects for our existing exporters. But that is not the real prize. The real prize is the trade investment nexus. The fact that we will be able to show this preferential access to a market of 3 billion people and tell people you can come and locate here and sell to that market. 20 miles away to probably the fastest growing large economy over the coming years. And preferential access to go back into China, preferential access to go into Europe, and preferential access to go into Pakistan as well. And of course, easy access to the Middle East, East Africa, etc. So that, for me, is a very, very powerful narrative. This preferential access allied with our strategic location, I think, is a major, major advantage. And if we can get our macro fundamentals right, if we can have a stable policy framework, we can go forward. I should also mention that the government is doing quite a lot in terms of the factor markets. As far as land is concerned, some of the old laws which are not entirely suitable in a modernizing economy are being reformed. On labor, there's a big effort in terms of education, training, and skills development, particularly in the STEM subjects, science, technology, engineering, and maths. Also, I should, and this again, people have probably heard me say, but I don't buy into this story that there is a labor shortage in this country. The problem is we have far too much labor in low productivity sectors. Agriculture, 28% of the workforce gives us 7% of GDP. Public service, 18% of the workforce. It has gone up from about 600,000 in 2005 to 1.5 million today. So there, and these people are behaving rationally. People are being trapped in low productivity, low income agriculture through free water, through subsidized fertilizer, guaranteed prices. We help them to get their noses above the water. But if you take $2.50 as the poverty line, almost 30% of the Sri Lankans. So $2.50 is what? Less than 400 rupees a day. Almost 30% of the Sri Lankans live below that. That is because we are trapping people in these kind of low productivity, low income livelihoods. If the new projects, if the Hambantota development, if the Trincomalee development, if the Kandy development, if the Kurunagala, Kuliyapiti development, all these things start generating jobs. Now the Chinese ambassador told me that they can generate $500 per month jobs in the Hambantota economic zone. That's about over 75,000 rupees a month. That will transform incentives. If at the same time we address some of the distortions that we have. Public service, everybody wants to be in the public service because that is the only component of the workforce which has a non-contributory pension. So people are behaving rationally. People are behaving rationally by sticking on to traditional agriculture. They're behaving rationally in terms of wanting a public service job. But we've got, that is because we have distorted incentives, which is pushing labor into low productivity activities. If the economy begins to take off and then more productive, higher value jobs are created, then clearly we need to then address these distortions which are trapping labor in the wrong places in the economy. So with that, let me say, I think the bottom line is, in my view, we have made some progress towards stabilization. There are some plans to build on that stability. There's a long way to go, but I hope we are getting to a situation where the domestic private sector in particular will have its animal spirits activated and will start opening its wallets. Because the most disappointing part of the post-conflict narrative has been investment, domestic and foreign investment. It's been extremely poor. I hope now the frameworks are being put in place for that to change. Thank you.